Welcome. Today we're taking a deep dive into the 2026 Global Outlook from the BlackRock Investment Institute, or the BII. And this isn't just their standard annual market forecast. This is really the synthesis of 2 full days of internal debate among their most senior people, portfolio managers, executives.
Right.
And it's all designed to form their absolute macro framing for the next 3 years.
Sure.
This is basically the blueprint for how one of the world's largest asset managers is thinking about risk and opportunity.
That's exactly right. And you have to see this outlook as a critical piece of strategic planning. Its central challenge, really, is reconciling these immense, almost clashing orders of magnitude within the global economy.
Clashing orders of magnitude.
Yeah.
What do you mean by that specifically?
Well, they are grappling with the sheer scale of the massive capital spending required by the artificial intelligence build-out, and then trying to square that with the actual tangible revenues that spending might realistically generate. So our mission today is to really unpack this vision. We're going to focus on 3 critical areas that define their strategy. The structural shift to what they call a new regime of volatility and leverage.
Right, the new regime.
Their specific high conviction stance on the physical constraints of this AI build-out, so infrastructure investment, and the precise geopolitical flashpoints they identify as layering systemic risk onto the global system.
Okay, let's unpack this then. BlackRock argues we are fundamentally in a world defined by 3 overwhelming interconnected mega forces.
Right. AI, the energy transition, and geopolitical fragmentation.
Exactly. And this is the critical distinction they make. They stress there is no neutral stance, not even when you hold broad, diversified market indexes.
And that signals a total fundamental shift in how we have to approach portfolio construction, right? You can't just diversify away from these drivers anymore.
You can't.
It's a very assertive, I would say almost aggressive stance. It suggests that the old rules of classical passive diversification are, well, fundamentally broken.
So if you think you're playing it safe with an index fund, you're actually not.
You're not. The concentration of market gains, driven by this handful of powerful forces, means that any portfolio action, or even inaction, like sticking with an equal-weighted index, is inherently a high-conviction view. If you're not actively leaning into the mega forces, they argue, you are actively making a bet against them. It's really a mandate for active management.
We absolutely have to start with AI then, because the BII explicitly argues that this is the dominant mega force right now. It's the thing driving the global economic and market transformation.
It is.
And the crucial pivot they identify is this profound structural shift. We are moving away from decades of what they call capital-light growth.
The typical model of the consumer internet, the digital revolution era.
Exactly. And we're moving into a new era of capital-intensive growth. And this transformation isn't just software anymore. It's physical. It's pushing physical, financial, and even socio-political limits all at the same time.
The scale is what makes this analysis so essential. I mean, we aren't talking about marginal upgrades to existing data centers.
No.
We are talking about a transformative infrastructure-level build-out, external estimates, which BlackRock incorporates into their thinking, for global AI corporate capital spending. I mean, the ambitions through 2030 range massively, but they land somewhere between $5 and $8 trillion?
$5 to $8 trillion.
And crucially, the vast majority of this commitment is concentrated right here in the U.S. It's potentially unprecedented in both its speed and its sheer scale compared to previous technological revolutions.
And here's where it gets, I think, really interesting, because BlackRock, as analysts, has to make the investment math work. They frame this as the core analytical challenge. Micro is macro math. Let's break down those numbers for our listeners, because this is where the entire thesis either stands or it falls.
Indeed. The first task is identifying what they call the critique point, the revenue gap. So let's take the upper end investment figure, which is $8 trillion in capital expenditure, spread over roughly 5 to 6 years.
Okay.
BlackRock is asking, what return must this produce for the companies making the investment? So if these tech companies, the hyperscalers, are aiming for a reasonable 9 to 12% internal rate of return, or IRR, their internal analysis calculates that the incremental revenues needed annually are just staggering, somewhere between $1.7 trillion and $2.5 trillion.
Wow. Okay. Just to pause there for a moment for the learner of the audience. When we talk about internal rate of return, IRR, we're essentially talking about the annualized rate of return they need to make this whole investment economically worthwhile. worthwhile, right?
That's it. It's the hurdle rate.
Yeah.
So $1.7 to $2.5 trillion annually in new revenue is the hurdle.
Okay, so that's what they need. What are the forecasts?
Precisely. And now we look at current consensus broker analyst forecasts for these major hyperscalers, the Amazons, the Googles, the Microsofts. Analysts currently forecast only a $1.6 trillion increase in total annual hyperscaler revenue through 2030.
So it falls short.
It clearly falls short of the minimum needed to justify that upper-end spending. So based on current micro-level forecasts, this investment, it just doesn't make sense. And this discrepancy is the financial hump they talk about, this large, high-risk, front-loaded spending period before the revenue benefits really materialize.
Wait, if the math doesn't actually work out on current forecasts, isn't BlackRock basically admitting that their overweight stance on U.S. stocks, especially the tech sector, is fundamentally a massive bet on speculation, not on current data? They must have a gargantuan justification to reconcile this gap and still be so bullish.
Well, their justification relies on a macroeconomic leap of faith that goes way beyond the micro-level company forecasts. They call it the growth breakout hope.
The growth breakout hope.
Yes. BlackRock estimates that the only way to close that revenue gap and justify the upper-end spending is if AI delivers a structural 1.5% boost to growth through economy-wide productivity gains.
1.5%. That's
It's
incredibly specific.
It is. And if that 1.5% productivity boost is achieved, BlackRock estimates it would expand economy-wide revenues by about $1.1 trillion per year.
Okay.
And that $1.1 trillion, combined with the current analyst forecasts and maybe some assumption of market share shifting, that would be enough to reconcile the $8 trillion capex.
I have to pause on that 1.5% boost because this is the pivotal assumption. This entire justification, then, hinges on the U.S. breaking out of its long-term 2% GDP growth trend. And that trend, as we know, has held remarkably stable for over 150 years. We're talking about achieving a 3.5% growth rate consistently.
That is the pivotal point, and frankly, where the criticism must start. BlackRock notes explicitly that past major recognized innovations, steam power, electricity, the entire digital revolution, ICT, they were not enough to achieve this consistent structural breakout over the last century and a half.
So it's never happened before.
Never. So achieving this breakout is, in their own words, a tall order. They are basing their core strategic view on an unprecedented event that has failed to materialize during every single previous industrial revolution we have witnessed.
So we really need to understand the intellectual maneuvering here. If past technologies didn't deliver this structural breakout, why on earth does BlackRock think AI will? It sounds like they're hanging their hat on a qualitative difference, not just, an acceleration of existing trends.
Exactly. Their thesis requires AI to be fundamentally different from previous revolutions. It relies on the estimate that AI will innovate the process of innovation itself.
Okay, what does that mean?
So instead of simply being a tool for existing businesses, the idea is that AI could begin autonomously generating, testing, and improving entirely new concepts. We're talking scientific breakthroughs in materials, science, drug discovery, battery technology, logistics systems, even genetic engineering.
I hear the language self-reinforcing loop of accelerating innovation, but that sounds a lot like the same kind of promise that was made right before the dot-com bubble burst.
It does.
Is there any concrete early metric that BlackRock cites to make this claim sound less like corporate enthusiasm and more like verifiable financial analysis?
Well, they acknowledge the inherent uncertainty. They're looking for leading indicators, things like a surge in new patent filings in AI-heavy sectors, or maybe a sudden unexpected drop in R&D cost-to-discovery ratios in pharma or material.
But nothing solid yet.
The fundamental truth remains. This is a speculative leap of faith that the investment math requires them to take. They are essentially betting that the micro does eventually become the macro, meaning the capex may pay off overall, but they admit the payoff requires a historical miracle.
So they stay overweight U.S. stocks.
They do, because the market concentration reflects this underlying economic concentration. But they stress that the next phase demands finding new winners as revenue spreads beyond just the core tech builders. The initial concentration demands a big call, but sustained success demands granular, active management.
And that front-loaded, speculative $8 trillion ambition brings us directly to the financial consequences and the resulting systemic risk.
Right.
BlackRock identifies a new, structurally unstable market dynamic, which they label the new regime of higher volatility and leverage. Let's start with theme 2, leveraging up the financing hump.
The financing hump is the core vulnerability of the system. We established that the AI build-out inherently requires massive front-loaded investment.
Right. Data centers, compute, energy.
So we're talking land acquisition, massive data centers, specialized compute, and all the energy infrastructure to power it. And all of this happens while the returns are backloaded and, as we just discussed, speculative. This gap must be bridged with long-term financing and, inevitably, greater leverage across the entire system.
The good news BlackRock cites is that the private sector, particularly the large listed tech companies, they started this cycle with extremely healthy balance sheets.
Correct. The largest hyperscalers and cloud spenders began with an average debt-to-equity ratio of only 0.54x as of November 2025.
So they have room to borrow.
They have significant headroom to lever up, and we've seen major tech firms successfully tap public and private credit markets with massive bond sales recently. The financing needs tied to this capex, however, still far exceed what even the most profitable firms can meet internally.
So they have to go to the credit markets.
Aggressively.
But this private sector leveraging isn't happening in a vacuum. It's occurring against a highly stressed financial backdrop of already highly leveraged public sector balance sheets. And this is the critical intersection that I think turbocharges systemic risk.
This is the dual leverage problem. We have stretched U.S. and U.K. fiscal deficits. We have Germany's necessary defense push following the suspension of its constitutional debt brake. We have Japan's new spending pledges aimed at stimulating its economy.
So governments are already deeply in debt.
Exactly. And these highly indebted governments have less capacity to cushion economic shocks, and critically, they are simultaneously competing with the private sector for capital in the bond markets.
So what's the resulting financial risk of this combined public and private debt surge? BlackRock mentions two key outcomes for this new regime.
The combination creates a global financial system that is, in their words, vulnerable to shocks. First, the higher borrowing across sectors demanding more capital inherently keeps upward pressure on interest rates globally. This leads to a structurally higher cost of capital for everyone, companies, governments, and consumers.
Okay, so borrowing gets more expensive for everybody. What's the second outcome?
Second, this vulnerability manifests as potential bond yield spikes tied to policy tensions. This is the conflict between central banks trying to manage persistent inflation and governments that need to service these massive ballooning debt loads.
And this vulnerability leads directly to their tactical position on fixed income, particularly the concept of the term premium. Could you explain for the listener why the term premium is so crucial right now?
Absolutely. The term premium it's essentially the extra compensation, the yield that investors demand for holding a long-duration bond, like a 30-year treasury, instead of just continually rolling over shorter duration debt like T-bills.
So it's the reward for taking on long-term risk.
Exactly. It compensates for two primary risks: the uncertainty around future inflation and the risk of unexpected shifts in monetary policy.
And BlackRock's point.
Their point is that the structural rise in public debt servicing costs and the high uncertainty around the economy's ability to absorb this AI capex means investors are demanding significantly more compensation for risk.
So the term premium has to go up.
It has to. Therefore, BlackRock is tactically underweight long-term U.S. Treasuries precisely because of this expected rising term premium. The traditional portfolio ballast, the idea that long-term Treasuries automatically cushion equity downturns, is failing in the new regime because both debt and equity markets are reacting to the same underlying forces: debt levels and the cost of capital.
Which brings us to theme 3, the diversification mirage. If structural risk is high and traditional hedges like Treasuries are ineffective, how do investors manage risk when the market is so concentrated in these mega forces?
The BII presents some really compelling data here illustrating the concentration reality. They show that after accounting for common factors like value and momentum, an ever larger share of U.S. equity returns reflects a single common driver, which is the AI mega force-related theme. Markets have profoundly less breadth than they did even 5 years ago. This concentration is a defining feature of the new regime.
The comparison using the S&P 500 data makes this point so starkly. It shows that passive risk management is now actually dangerous.
That's the crux of the mirage. Attempts to diversify passively away from the U.S. or AI, maybe by using an equal-weighted index, well, BlackRock now deems those big active bets.
An active bet, even though it's a passive strategy.
Right. LSEG data shows that the equal-weighted S&P 500 was up only 3% this year versus 11% for the market cap-weighted S&P. If you chose the equal-weighted approach, believing you were safely diversified across 500 companies, you were actually making a large, explicit active bet against the dominant driver of returns, the AI megaforce. BlackRock argues that investors need to stop spreading risk indiscriminately and start owning it deliberately through high-conviction thematic strategies.
So the solution is abandoning broad asset classes entirely for more granular theme-based positioning.
Exactly. The new regime requires a shift to more granular, nimbler positioning and themes. You need to look through the index to the fundamental drivers. This is why BlackRock champions high-conviction strategies like private markets and hedge funds,
Right.
not just because they seek higher returns, but because they are capable of accessing truly idiosyncratic return sources, meaning returns that are uncorrelated with a major tech theme driving the public markets. This is where manager skill and active selection truly show their value in protecting capital from systemic shocks.
And the final point in this section is the dispersion in private credit, which BlackRock uses as a concrete volatility indicator, showing that stress is already building in certain corners of the debt market.
Right. Private credit, which has seen explosive growth over the last decade, is entering a much more uneven phase. While large established lenders are resilient and often linked to the strong private equity sponsors, pressure is concentrating among smaller and newer entrants.
Why there specifically?
Well, this is due to years of compressed spreads and often compromised credit standards that occurred during the easy money era. Those are now being tested by higher rates and slower deal flow.
And the data BlackRock cites shows exactly where the pain is.
It does. Covenant default rates. So
Yes.
the failure to meet financial conditions laid out in the loan agreements among smaller borrowers, defined as those under 10 million in EBITDA, are significantly higher compared to their larger counterparts. This is clear evidence of widening dispersion.
What's truly insightful, I think, is how BlackRock links this credit stress back to the primary megaforce, AI. Because AI isn't just a growth driver for the big tech firms, it's an existential threat to some businesses. And that risk is showing up in the credit market.
Absolutely. They warn that dispersion will be evident not just by size, but by industry exposure. Businesses heavily exposed to the cyclical consumer, or critically, those threatened by AI-driven automation, are most at risk of default.
So who are we talking about here?
Think of legacy software firms, certain service industries, or low-margin logistics providers ripe for disruption. This highlights that active credit management is crucial. They expect a necessary market correction where poorly structured deals unwind, clearly distinguishing the disciplined lenders from those who were complacent during the boom.
The financial model relies on that $8 trillion being spent, but we transition now to the physical limits of that ambition, which is theme 2 from the BII outlook. BlackRock is remarkably clear about this. The most immediate threat to the CapEx plan is not financial speculation or political gridlock. It's physical constraint, specifically energy.
This is a massive, immediate choke point. BlackRock explicitly states that the AI build-out faces political and financial constraints, but physical constraints involving compute and, most importantly, energy are the most binding constraints right now.
And the numbers are just.
The demand figures are truly unprecedented and, frankly, difficult to conceptualize. AI data centers could use 15 to 20% of current total U.S. electricity demand by 2030.
15 to 20% of the entire country's electricity in less than 6 years. That's just for running algorithms and heating servers. It's staggering.
It is. And some external estimates even suggest demand could approach a quarter of current demand. This tests the limits of the entire power grid, the natural gas and fossil fuel industries, and the critical materials supply chain like copper and rare earths.
And that infrastructure is already stressed and very slow-moving.
It's already stressed. Rising power demand collides with an existing massive backlog of renewable and transmission projects that are just waiting to connect to the electric grid. And that's coupled with notoriously slow permitting processes, particularly in North America and Western Europe.
So if these limits bite,
If permitting lags or the grid cannot cope with both generation and transmission CapEx plans will be walked back. This would immediately crimp the overall ambition of the AI build-out and, crucially, endanger that 1.5% productivity boost that BlackRock's entire thesis hinges on. As one of their managers put it starkly, companies haven't struggled to get chips. The real constraint is land and energy.
this dire, immediate need for reliable power and land, then, it defines BlackRock's bullish investment stance on infrastructure.
They view infrastructure as an indispensable, almost defensive asset class. Their logic is sound. Regardless of which tech company ultimately wins the AI race, that winner will rely completely on the physical foundation.
It doesn't matter who wins, they all need power.
They all need power, data fiber networks, physical land, and the connectivity provided by infrastructure companies. It acts as a defensive characteristic because these assets typically have regulated or long-term contracted cash flows, which BlackRock finds highly attractive in this volatile new regime.
And they see a clear, time-limited market opportunity in listed infrastructure valuations.
Yes. They note that listed infrastructure currently trades at a deep discount relative to public equities. They state this discount is comparable to the valuation shock we saw during the COVID-19 crisis and even below global financial crisis levels.
And why is that?
Crucially, they attribute this discount not to deteriorating fundamentals, the need for power is only increasing, but largely to the interest rate uncertainty we discussed in Section 2. In their view, this creates an attractive, long-term entry point for institutional investors who have capital that can ride out short-term rate uncertainty.
Given the debt limits of the public sector, governments are competing with companies for capital. Private capital has to play an enormous role here, especially in areas where governments are just too slow to act.
Absolutely. Given elevated government debt, BlackRock sees private capital as central to bridging this energy supply-demand gap. This includes significant opportunities in private infrastructure funds, which offer investors greater control and exposure to specialized, essential assets that are harder to find in public markets.
Like what, for example?
They cite specialized areas like carbon capture and storage, necessary grid modernization projects, or biofuels as critical multi-decade investment needs, and they're underpinned by both the AI and the energy transition mega forces.
Let's contrast this with the global AI race perspective they offer, which features a sharp contrast with China and its handling of these physical constraints.
BlackRock highlights China as a strategic competitor that appears to be handling the physical constraint challenge more effectively, and that's due to its centrally coordinated top-down approach.
Right.
China is building power generation, nuclear, coal, hydro, and renewables and transmission at pace. They are achieving on-time and on-budget nuclear reactors, for instance, in a way that is incredibly difficult in the West due to permitting and, enablism.
Not in my backyard.
Right. This aggressive, coordinated build-out gives China distinct advantages in deploying massive, power-intensive data centers, which need cheap, stable, and clean energy. This infrastructure capability is critical to winning the AI race.
They also note a detail about China's AI models specifically regarding energy efficiency, suggesting a dual track of competition. It's not just about scale, it's also about efficiency.
They note the focus this year on highly energy-efficient Chinese AI models, specifically referencing one called DeepSeek. This focus suggests that reduced energy needs could partly ease the constraints globally. But the main takeaway remains that China's aggressive, nationally coordinated infrastructure build-out is noted as a core competitive advantage in the global AI race.
So for investors?
For investors, BlackRock's implication here is clear. Target the physical choke points. Power systems, critical minerals, supply chains like copper and lithium, and beneficiaries of necessary permitting and utility reform. Those assets are indispensable.
The third great megaforce is geopolitical fragmentation, which is fundamentally reshaping capital flows and, perhaps surprisingly, creating significant new investment opportunities far away from Silicon Valley.
How does BlackRock define this new world order we are entering?
They argue we have entered the third distinct world order since World War II. The first was the Cold War. The second was the post-Cold War era of globalization and peak efficiency.
Right.
This third era is characterized by the U.S. fundamentally resetting its economic and geopolitical relationships. It's emphasizing transactional trade over multilateral treaties, it's adopting powerful new industrial policies like the Inflation Reduction Act, and it's resetting alliances to advance specific domestic and security interests. This is a decisive structural break from the previous 30 years of reliance on optimal efficiency.
And the U.S.-China rivalry remains the central feature, defining geopolitical competition across technology, energy, trade, and defense.
And AI is directly at the center of that rivalry. Both nations view AI as the key technology determining future economic dominance and military advantage this century. So what does that mean in practice?
Consequently, both are undertaking massive, coordinated efforts to curb strategic dependencies that can be weaponized, meaning dependence on things like chips, rare earths, or specific components that a rival could cut off. This structural shift is a clear move away from optimal global efficiency toward expensive, complex resilience and secure supply chains.
This fragmentation creates what BlackRock calls layered volatility. They don't just mention abstract risk, they list specific, highly sensitive flashpoints that are actively complicating the investment environment.
Exactly. The environment is already structurally elevated risk due to the U.S.-China dynamic, and that is compounded by current regional conflicts that threaten commodity flows and energy prices. They list three.
Okay, what are they?
One, the ongoing high-intensity war of attrition in Ukraine, which ties up capital and resources in Europe. Two, an uncertain peace in Gaza amid profound structural regional change, which keeps crude oil and shipping lanes highly volatile.
And the third.
And a very specific item they list, the largest U.S. buildup of forces in the Caribbean in decades.
The Caribbean buildup. That's a telling inclusion. It suggests BlackRock is focused on geopolitical risks that directly affect key supply chain nodes for the U.S. and regional stability that impacts investment appetite in Latin America.
That's the interpretation. That specific risk, tied to regional disputes and potentially unstable regimes near major maritime choke points, highlights a focus on supply chain security and energy flow disruption close to home. These three specific risks directly feed into global commodity prices, defense spending forecasts, and political risk premiums in neighboring emerging markets.
Let's look at the European response and investment opportunities driven by this geopolitical urgency. Europe was slow to react to fragmentation, but that seems to have completely changed.
Europe's urgency has been completely restored by rising U.S. protectionism and a conflict in Ukraine, which exposed their defense and energy vulnerabilities. The most dramatic consequence is the push in defense spending.
Right.
NATO allies committed to boosting defense spending to a new, higher medium-term target of 5% of GDP by 2035.
5%. After decades of struggling to even hit 2%.
Exactly. It's a massive, multi-decade structural shift in capital allocation. Germany, for example, has even suspended its constitutional debt brake to raise defense and infrastructure spend immediately.
That commitment to 5% of GDP over the medium term creates massive, sustained investment implications.
It creates powerful medium-term opportunities in European defense technology, aerospace, and specialized equipment providers. Additionally, Europe's inherent energy vulnerability, its reliance on imports and elevated power prices, is driving domestic policy changes.
So they're forced to invest.
They're forced to invest in resilience. Looser fiscal rules are boosting energy investment, which BlackRock sees as a structural positive driver for European utilities, supported by new EU regulations aimed at promoting competition and radically reducing permitting times for clean energy projects.
Now to emerging markets, or EM, where fragmentation leads to the rewiring of global trade. This structural shift, which values resilience over pure cost, benefits specific regions directly.
It does. Global companies are aggressively prioritizing supply chain resilience and diversification. This leads to a physical rewiring of supply chains away from concentration risk. This friendshoring, or nearshoring, immediately benefits countries like Mexico, Brazil, and Vietnam.
And the numbers back that up.
They do. Mexico, due to its strategic proximity to the U.S., saw foreign direct investment hit a record $41 billion in the first 9 months of 2025 alone, driven purely by this nearshoring trend.
Latin America is clearly positioned well, not just geographically, but because its resource wealth ties directly into the other mega force, the energy transition.
That's the key linkage that makes the region a dual play. Brazil is already a global leader in renewables, sourcing 88% of its electricity from renewable sources in 2024. Chile is the world's largest copper producer and the second largest lithium producer. These resources are absolutely essential for the massive energy transition and AI infrastructure build-out globally. So BlackRock likes energy, mining, and infrastructure in the region, noting that countries like Mexico and Colombia can leverage their roles in supply chains and logistics hubs for this new, fragmented global commerce.
Given the historical volatility of Latin American markets, what's BlackRock's preference regarding debt exposure? They are typically cautious about local risks.
They exhibit clear caution regarding currency and inflation risk, which are perennial challenges in Latin America. BlackRock explicitly prefers hard currency debt over local currency bonds to reduce foreign exchange and inflation risk, and to potentially offset impacts from political shifts as the region enters an electoral cycle.
So they're playing it safer on the debt side.
Yeah. They are, but they do note that the region is showing greater fiscal discipline overall. Mexico and Brazil are implementing credible, stabilizing policies and have robust buffers against external shocks. Though they do flag Colombia as seeing some fiscal slippage, The preference for hard currency debt is an active risk mitigation strategy in a region with enormous structural potential.
And finally, their long-term conviction bet in the EM space, India.
This is noted as a major strategic allocation for 5 years and beyond. BlackRock favors above-benchmark allocations to Indian equities, citing structural strengths that insulate it from the worst of the volatility we discussed earlier.
And what are those strengths?
A young and rapidly expanding workforce, a massive demographic advantage over aging developed economies, rapid digitization of its economy, and its inherent geopolitical resilience.
They use specific jargon for India, a multi-aligned and connector country. For the listener, what exactly does that mean in practical investment terms?
Multi-aligned is a great term for this New World Order. It means BlackRock sees India as a diplomatic and economic hub that benefits from fragmentation by intentionally being everyone's partner. It cooperates with the U.S., engages with Russia, maintains ties with the Gulf states.
So it's not picking a side in the U.S.-China conflict.
Exactly, and it's therefore far less exposed to the direct, destructive U.S.-China tensions. And as a connector, it acts as a critical link in the rewiring of global trade and technology, capturing manufacturing and service contracts that are diversifying out of China. Its large and expanding working-age population sets the stage for sustained gains in productivity and consumption, providing a powerful long-term growth engine.
So on a strategic time horizon, India is viewed as a necessary hedge against geopolitical fragmentation and a pure, unconstrained play on demographics and digitization. It's an explicit counterbalance to the risks building up in the West.
If we connect this all back to the bigger picture, BlackRock's outlook confirms we are firmly in a bifurcated, leveraged, and highly complex world. The core takeaway isn't merely that AI is big, it's that AI forces a dangerous leveraging up strategy across both corporate balance sheets and global fiscal deficits that fundamentally increases system-wide risk and makes traditional passive diversification useless. They recognize, critically, that their own bullish thesis requires the U.S. economy to achieve a structural productivity breakthrough that has evaded every single previous revolution in the last century and a half.
So what does this all mean for you, the listener? Well, passive investing, as we knew it, is now viewed by the BII as a big active bet on this handful of mega forces, mainly AI. The path forward requires granular, active management focused on deep, theme-based conviction, not broad indexes. Investment must be strategically directed toward infrastructure to solve that physical energy crisis choke point. And patient capital should flow into countries benefiting from geopolitical fragmentation and the rewiring of trade, specifically India and Mexico. The message is to be deliberate, to be tactical, and to accept that structural risk is now fundamentally higher.
And this raises the final important question that every investor, professional or amateur, must grapple with. BlackRock's entire $8 trillion highly leveraged AI thesis depends entirely on the U.S. economy achieving that 1.5% growth breakout it hasn't managed in 150 years.
Right.
If, despite the massive front-loaded debt already being accrued, the revenue gap is not closed by this unprecedented productivity surge, if the historical trend holds, what precise level of systemic financial shock is inevitable when both public and private balance sheets are simultaneously leveraged to this extreme? That gap between the required IRR and the current revenue forecast remains the market's biggest, most unsettling uncertainty.